Good morning. Happy Monday. Welcome to the Monday Market Update. My name is Nash Paradise, and boy, do we have a week in front of us here. So let's jump right in, talk about what happened. You know, you would think coming back from Fed week that the conversation would be all about the Fed. And it's going to be a little bit about the Fed. You know, Fed came in last week. We got that rate drop that I called and said was going to happen. Andrew Cady said not. And guess where he is? Not here. So he is in so much shame from his hot take that was incorrect. He did not want to give me credit for being right on that he couldn't be here. No, he's got other stuff planned, but I will take my victory lap on, picking something that had a 90% certainty. Probably not a victory lap there, but the Fed did cut rates, and look what happened to our mortgage rates. They got better. Wait, no, got worse? Got worse. It was a funny week. We got the Fed cut midweek. Things got a little bit better. They were worse beforehand. And overall, we finished up a little down, then a little back up again. So we've moved, and last week was fairly high volatility, but this week, significantly higher volatility. Let's talk about what the chart looks like last week and what we went into here. ADP employment change was fairly interesting in that, it came in a little bit on the light side. Interest rate decision, 3.75 is a prevailing overnight rate from the Fed. We knew that was going to happen. Cool. The dot plot was the bigger story. The Federal Open Markets Committee, meeting notes were important, but Powell's Powell's presser is always huge. And Powell has been really rough on mortgage rates. His clash with our current administration has seen a lot of back and forth, a lot of, aggressive tone, far from a foregone conclusion that we'd see a December cut. Well, we had a conclusion that there would be a December cut, and we got the December cut. There was a little bit of a dissenting opinion from some of the members, but ultimately the most recent jobs data, however limited, gave us the cut that we were looking for. So, initial jobless claims, interestingly enough, it came in higher, but yet the jobs report was a mixed bag last week. We had initial claims that were slightly up, continued claims were down, which was contradictory to the ADP data. And what that really points to is the fact that the jobs report and the ADP reports, a lot of these are adjusted seasonally. We had a very late Thanksgiving this year, which messed up some of those reports a little bit. So not a ton of stock going into those, knowing that what we're getting this week is that good. So let's take a look at what's going on this week. Yeah, you probably can't read that. That's a lot. It's a very, very heavy week. This is the heaviest week that we've had since the government shut down. So this is huge. It's very, very, very data driven. Let's talk about this. I'm gonna run through it on my screen where I can see what's going on here. So interesting thing today, normally the New York Fed manufacturing index isn't that big of a market mover, but the forecast was a 10. It came in negative 3.9. So manufacturing down significantly from what was anticipated, moved things in our interest a little bit. 10-year Treasury bond down slightly to about a 4.15, had been hovering around 4.19. So we want to see that come down. So that's good for interest rates. Tuesday is a big day. We've got ADP employment change weekly. We've got non-farm payrolls, first non-farm payrolls that we've had in a hot minute. Got retail sales control group month over month, the November non-farm payrolls, and this is going to be a big one because it's full data. I find it interesting that the NFP projection right now is 40,000 jobs added. We'll see. That's a pretty low projection. If we miss low on that, it could be really good for interest rates and unemployment rate month over month. Previous was 4.4%. Current projections are 4.4%. That unemployment rate comes in a little bit higher. That's going to do really good things for the treasuries and interest rates. So Tuesday is a huge day. But even looking through later in the week, Thursday, we've got inflation numbers. We got month over month core CPI for November and the year over year. So the monthly is projected up 0.3%. Yearly inflation numbers at, 0.3 and then 3. So, I mean, we'll see that 0.3% with rounding. We've got room to come in low on inflation. We have room to come in. This week is everything. So, we'll see where we're going with that. Let's talk about the Fed rate and rate cuts and where things are going here in the future. That 375 mark, we're definitely going to hold for a while. We'll definitely hold through the next meeting. I find it interesting that the dot plot did have a few people suggesting a rate cut by January. I think that would be way too soon and probably impact mortgage rates negatively. I was thinking my projection was that April cut was the one to circle because I think that's, it's projected 85% likely at this point. I think that's where we see our first Fed rate cut of the year. It's been a while since we've had like a 50-50, and I think March may very well do that. We'll know a little bit more after the reports this week. If we see a March drop in the Fed funds rate, I think it's too soon. I think we need to sit in this pause, let data, come to fruition type moment. And again, that could be negative for interest rates. So don't be crossing your fingers for an early cut. We want this to be balanced out enough. That last December cut was forecasted and telegraphed perfectly by me and a bunch of smarter people. And, rates got better because Powell didn't say, oh, yeah, we've got conflicting data and the next cut's not assured. Like, we're down in this range now where we're going to get pretty close to our target. You can see on this, we're holding steady at that 3.25, forecasted as soon as July, but all the way through the end of 2027. All the dot plot data says we're going to get there and hold. So there's not a huge rush to get there. We know where the Fed is going on their funds rate. So if we can just get there in a reasonable amount of time with 2 cuts next year, everything will move nice and steady. So to wrap this up and put a bow on it here pretty quickly, this is a wild week. Incredibly difficult. We're looking, I think we got one more chart here, Caden, with what happened to interest rates. Yep. We have been hovering up and down, up and down, up and down since September. And, I'm not mad that we're staying in this zone. This is a zone that we've been able to hold in pretty nicely. I feel like this week, what we see has the potential to really push us down through that floor. We've almost established a new ceiling on the 10-year treasuries of that 419, maybe 420. We're fairly close to that right now. So as far as where do we have room to move, based on the data that we've had, where the Fed's going, all these things, the room to move is down. I'm not necessarily giving a float alert here, but what I am saying is now is a good time to reach out to your current pipeline, reach out to borrowers who are considering refinancing sometime next year, and let them know that, hey, we need to be keeping an eye on things because if it moves quick. Look at these drops that we had in September and then one towards latter part of October. They were very, very short. They did not last long. This could be the ledge that we've been waiting to fall off on that could get interest rates back down closer to that 6% mark. So, a little wishful thinking, a little aggressive, mortgage broker hope here, but the hope is backed by what we're seeing in market data, and we'll just roll and see what we have from there. So we'll be back next week. Appreciate everyone tuning in. Y'all have an awesome week.